Today, I'm sitting down with Dan Dyck from Solomon Financial, and we're talking about something most business owners know they should think about, but many avoid. We're talking about protecting your family, your business, and your business partners, and planning for the unexpected. I also want to hear Dan's personal story and why he's passionate about helping people in this area. So, Dan, welcome.
Thanks for having me, Willy.
Dan, before we talk about business and insurance, tell us a little bit about yourself and your story.
Yeah, for sure. So that's a long story. It goes back quite a ways.
Okay.
It's starting to get longer. But yeah, I started in the financial industry when I was 19 years old. And my wife, I got married when I was 21, and she joined me in the financial industry, Krista. And so we've been doing it together ever since. And so I think we're coming about 32 years in the financial business together. But about 8 years ago, we kind of became disillusioned with where the financial industry was at, kind of some of the practices in the financial industry, and how we interacted with clients. And so we decided we would strike out on our own and see if we could solve some of those issues. So in 2018, we left the company that we were with, and the two of us not really knowing how it was going to work out, but we felt pretty confident. We felt like we had thought hard about it, we had prayed about it, and felt good about where the direction we were going to go. And so, we launched Solomon Financial in 2018. And it felt like at the beginning it was a bit of an experiment to see, would this actually work? Specifically, would we be able to attract advisors that would be willing to work in teams, share the pie instead of hoard the tart?
Yeah, sure. Okay.
And actually work with clients in their own lanes, doing the things that they're really good at, and allowing for other advisors to shore up the things they're not good at. So we could each kind of, operate in our area that we were passionate about. And so that experiment turned into, this might actually work. And today we have near 200 advisors. We're open in every province in Canada. And we actually also own a mutual fund dealership, and that's grown an awful lot over the last few years as well. So that's kind of our story, and we feel like it's been a really fun ride, and it still is.
Okay,
So,
awesome. And was there a moment in life where you realized how important financial protection really is? Or
Yeah. Well, I mean, two different things there actually. One is I grew up in a home. My dad was a pastor, and so my dad's still my hero. He's like the guy I want to be when I grow up.
Nice.
He's long since retired, but when I think about what my mom and dad did to raise 4 boys on a pastor's income, it was extraordinary, but it was tough.
Yeah.
And so I remember as a young man thinking, I would love to be in a position to be able to do the things that I'm passionate about in terms of serving and ministry and things like that, but not to be tied to somebody else's idea of what that was worth, paycheck wise and that kind of thing.
Yeah.
So that was one thing that motivated me, and I really cut my teeth and still do work with a lot of middle income families just to try and get them through those tough years of raising kids and paying bills and paying down mortgages and all that kind of stuff. So I was really passionate about that. But then about 12 years ago, I actually lost my best friend, and he left a wife and 3 kids, and we had some opportunities to really work on his financial position before he ever found out he was ill. And so that also kind of drives my passion a little bit, knowing that can be life-changing kind of work. Yeah. So I would say initially it was more for me about just about teaching people how to be good stewards of money. But then that's been added to more recently with what about protecting that? Once we've done a good job, we just want to protect it well and protect our families well.
Yeah. Awesome. And to shift right into business, you work with a lot of business owners. What are some of the biggest mistakes you see people make financially?
Yeah, that's a long list. And I will say this, business owners are a smart bunch and they're a fun bunch. That's part of, because I'm a business owner, part of why I'm passionate about working with business owners is because I identify with them. I feel the same fears and the same excitements and all that kind of stuff. So with Solomon, what it's allowed me to do is to find the lane that I'm passionate about and work heavily in that lane. And for me, that's business structures and long-term planning and different things like that. But then we also have a lot of support behind us from experts that deal with, family trust and estate practitioners and all that kind of stuff as well. So that helps. Now, the mistakes that I see a lot of business owners make. Business owners are like, typically just head down, let's go to work. Yep. Let the smoke fly and let's see what happens. Yep. So we're very much a fly by the seat of our pants kind of group.
Absolutely.
Now there's some business owners that break that mold. It's not everybody, but but I would say the majority of business owners are more about action than they are about planning. And so some of the mistakes I see them make a lot of times is they almost become a victim of their own success. They actually see some success and they're rocking and rolling, but maybe cash flow is not keeping up. Maybe they've acquired some debt, which I'm actually not at all opposed to. But maybe they've acquired some debt and they haven't kept up the cash flows, or they have so much growth, but their staff can't keep up, that kind of stuff. In my world, where that turns over into my world is a lot of things get missed in that process. Okay. Proper corporate structures, for example. What I see a lot of is business owners will start an operating company. They don't even think about anything beyond that. They're just thinking about, let's make this thing successful.
That was me.
Yeah, like it's like knuckle down, let's go to work.
Yeah.
And so one of the primary mistakes I see them make is they will begin to have some success in the operating company. They will, a common example is they might buy a piece of real estate, like a shop or a building or something like that, and they'll keep that in their operating company. And they're not thinking long-term about, what if I ever sell this thing?
Yeah.
Is the buyer interested in buying my building? Or are they more interested in just buying the business? Yeah. So that can be problematic, because if I want to do a share sale down the road, and I want to plan for that, because it's wonderful to get our lifetime capital gains exemptions when we sell the business. So if I want to sell it down the road, I got to start planning in advance for what that's going to look like. I might have a buyer come to me and say, I want to buy your operations, but not your building. Now I got a problem. Yeah. Because my building might have been in there for 20 years, growing in value. Yeah. And now if I do want to sell the shares of the company, I have to move assets out that are taxable. That's right. And that's going to hit me hard bottom line, instead of being able to sell it as part of that share sale. Another common mistake is a lot of times I see business owners that don't add their wife to ownership in the company.
Okay, yeah.
And I mean, there's various reasons for that. I'm not going to talk about the social reasons for that. But there are tax reasons and economic reasons why you should. Yeah. And so quite often I'll just ask that question. So is that, did you plan that, or is there a reason behind it? And they're like, no, we just didn't think about it. Yeah. Yeah. And, okay.
And the tax thing is a whole nother thing.
Totally.
Right? Tax planning.
And I think that comes down to a core assumption that I'm a business owner, should know this stuff. Nope. No. That's why you have people that do what they do. Yeah,
I was so unknown in all of this until people like you said, "Hey, you need this," and I'm thankful for a guy that was determined. You need to plan ahead, and I wasn't thinking ahead, but he made me start think more ahead and start planning for that. And so the other thing, I had a question, what do you think so many business owners avoid talking about life insurance or planning ahead? It's kind of...
Yeah, I mean, it's a good question.
Why do they avoid? Or like, that was me. I was gonna, like, I kind of just shut down when somebody talked about that kind of stuff.
I think there's a couple reasons. I do think part of it's personality. As a business owner myself, we feel 7 feet tall and bulletproof. Like, we can get this done. It's all on me, kind of thing. So we don't really think about the worst case scenario, and that's actually, in my opinion, it's a strength in business. You got to assess risk. You have to do that, but it's a learned behavior. And for a lot of people that are in business, they're optimistic, they're excited, they're challenged, they're like, let's go. You know, they don't like actually stopping and thinking about, well, what happens if? So you need people around you that'll discuss that with you and have candid conversations with you. So that's one. I think part of it's personality. I think the other part of it, though, is just busyness. They're actually open to having those conversations if somebody, like you said, somebody forced you to sit down and talk about it. But it's like, oh, okay, yeah, it's one more thing I got to do on my agenda.
Yeah.
You know, I have to finish payroll. I have to get the trucks out on the highway. I have to work my dispatch. And then I have to talk about life insurance.
Yeah.
You know, that's going to get down to the bottom of the list every time.
Absolutely.
So that's what I would say is there's two reasons for that. There's also actually a third, and that's the mystery of it. We're afraid.
Yeah.
My personality type, I want to read the menu before I walk in the restaurant. My kids will tell you, there's been lots of times where we've gone into a restaurant, sat down, I open the menu, and there's 8 or 9 of us around the table. I'm like, nope. Close it up and walked out, and the kids are like, oh, Dad's gone. I guess we're not eating here. So I like to have like that sneak preview, you know. So when we're dealing with business owners, we get that. So we're always saying, look, the back door's right there. We're easy to get rid of. Let's just have a conversation about it. Put some real numbers on the table so that then you can go away and think about it.
For sure.
You need to talk to, you know, as a couple, if that's the case, or as partners, if that's the case, without us staring at you waiting for a decision. You know, just go away and think about it.
Yeah.
So if you can give them that space, then I think it's less scary.
Yeah.
You know, give them numbers, give them reality, give them space.
Yeah. And what I had here for the next question was, what can happen when a family or a business is going through something unexpected that they had not seen coming at all, and they didn't plan for it? Like,
Yeah, is it okay if I share a story here?
Absolutely.
So I've had front row for both, you know, really well established plans, and then just things that got missed, both sides. So what can go wrong? I had a client that came to me after this event happened, and the situation was, I might get these numbers a little off, but it's going to be close. But the client came to us, and I think he was about 62 at the time, and he had been in business with his brother partners.
Yeah.
They had run business for like years. I think it was decades that they had been together. Really successful business, but his brother passed, and it was unexpected. So there was there was a unanimous shareholders agreement. Sometimes that gets missed. Just having a proper agreement.
Yeah.
But there was a proper agreement, but there was no funding mechanism for what happens if. So specifically, there was no corporately held life insurance.
Yeah.
So the brother passed. That put the surviving partner, the client, in a position where they owed the widow, his brother's widow, $4 million and to pay out her half of the business.
Yeah.
So there's a properly designed agreement saying if this person passes, the other person has the option to buy out the spouse, and the spouse cannot refuse.
Yeah.
But the payment to the spouse wasn't accounted for. How are we going to actually pay for that? There wasn't $4 million in liquid cash.
Yeah.
You know, there's a lot of business owners that they have a very high net worth, but not that much in liquidity.
That's right.
So in that case, it worked out in the end. But in that case, he had to go to the bank, get a $4 million loan, and he spent the next roughly 5 years paying off that $4 million loan, which, you know, happy day that he actually had the profit to do that.
Yeah.
And then he was able then to move into the process of selling the company. So those types of things, that one had a reasonably happy ending. But had he had insurance on his brother and brother vice versa, that would have been pennies on the dollar, you know, to pay out $4 million.
That's right.
There might have been hundreds of thousands of dollars spent on insurance, which sounds steep, but not in comparison to having to borrow $4 million from the bank when the time comes. So that's one thing that can go wrong. Other things that can go wrong is a lot of times in a unanimous shareholders agreement, there's just not really good expectations around things like limited capacity or incapacity. Again, things we don't like thinking about, you know, but if we have a partner that we're in business with, and that partner has some kind of an event in their life that they can't come to work anymore, have we dealt with that? Have we covered that risk? So I've seen some difficult situations like that. One in particular where the guy got in a car wreck and had some pretty serious brain damage, so couldn't come to work anymore, couldn't have didn't have great continuity of thought, so he couldn't be an influence in the business anymore. Hard conversations, difficult to deal with, and in that case, there was no plan in place to deal with that. So then it gets tough, you know. But some pre-planning, pennies on the dollar, makes it pretty simple.
Awesome. Yeah. And let's shift into kind of the options for insurance. So I had written down here, there's the term insurance policy, whole life insurance policy, and also you offer the universal life insurance policy, right?
Yeah,
And can you talk about the difference in between those?
for sure.
And where they fit the best?
Yeah. I think first of all, they all have a place.
Yeah.
You know, and that's one I think of the mysteries in our industry. People are always talking about what's the best. Yes, yes.
Yeah.
Like it just depends on your situation. So if I have a client, for example, that comes to me and says, "We've got a $2 million term loan at the bank. It's a 10-year term. We're going to get the thing paid off in 10 years. We'd like some coverage to make sure that if one of us passes, we can pay that thing off." So in that case, term insurance just makes perfect sense. We'll buy a 10-year term.
Yeah.
Another place where term insurance makes really good sense is if we have a business owner that sees the value of permanent insurance. Permanent covers whole life and universal life. But if we see a value in that, but we don't have the cash flow for it yet, then a term insurance can be great because
term insurance isn't as much input up front. Right?
exactly,
Yeah,
it's very low cost,
Yeah.
right? It's and I should say it's very low commitment because in my opinion they're all pretty low cost compared to what you get.
Yeah.
But it's very low commitment on terms. So I can meet with a 35-year-old business owner and put $3 million on him for a couple $100 a month. Now that's off the top of my head. I don't know exactly what it is, but it's very inexpensive and covers a ton of risk. So term makes a lot of sense in that case. And even if a client is saying, no, I really want a permanent policy, why would they want permanent? Well, they see that the risk is going to, or the risk or the reward is going to live past age 85. So they want to make sure they have the ability. Or they see the term renewal rates. Term renewal rates are punishing. They're like super, super high. So if you've had any kind of a health event and you have to renew that policy, it's your only option, it's very punishing. So a lot of people will convert it to a permanent at some point, particularly business owners. They like the permanent side. But I'll usually pull them back from that if cash flow is tight. So if cash flow is tight, it's okay. Let's just get the risk coverage in place while you're healthy. Sometimes while you're young, not always.
Yeah.
Some of us are still buying insurance and we're not that young anymore. But if we can get it in place, that then place marks that amount of risk coverage for the rest of your life if you can convert it, if you have the cash flow to convert it. And you don't have to prove insurability again. You don't have to, do all your financials again. You can just flip the switch and change it. So that allows them to get in the game and cover the risk. That's term insurance. Then if we look at whole life and universal life, without getting into the deep weeds on those two products, but just a simple overview, whole life is a solid product for people that have a really solid funding mechanism. So if they know I can easily make this premium payment. Of course, with whole life and universal life, a good chunk of the money goes towards long-term investment, not just the insurance cost.
That's right.
But they have to be able to fund that excess money going into the investment.
Yeah.
In whole life particularly, it's not as flexible. So if they have a really solid funding mechanism, it makes great sense. There's also strategies that we can use whole life for that we really can't use universal life for, like immediate financing arrangements.
I was going to ask about that because that's a lot of people ask, like, I can actually borrow against that
You got
policy.
it. Yeah.
Maybe talk about that a little bit too.
So in whole life, I might, we will have business owners that will be committing larger amounts, like maybe $100,000 per year because they have a high risk that they're trying to cover or whatever the case, and they want it to last a long time and they only want to pay for it for 10 years and be done. So they might commit a large amount, but they can maybe borrow that money back as well from the bank every year. So the money goes in, $100,000, they might be able to borrow $70,000, $80,000, $90,000 back every year at a really favorable rate from a third-party lender like a bank. And we arrange those for people. So it doesn't tie up their cash flow so much. And the interest becomes tax deductible as they're borrowing that money, and so does the cost of insurance because they're using it as collateral for a loan. So that's a versatility that universal life doesn't enjoy. Whole life does. Universal life, the advantages of universal life is they're extraordinarily flexible. I can put in no money in a year. I can put in $100,000 in a year. It's up to me and my cash flow and how I'm feeling about my investment. The other flexibility with universal life is that I can pick my own investments, and they can be pretty aggressive. You can be very conservative, like GIC type investing, all the way to investing in indexes like the NASDAQ or the Euro 100 or the S&P 500, investments that probably a lot of business owners are quite comfortable with because they understand business. Yeah. So it offers a high level of flexibility. You can still borrow against it, just not to the same degree, because lenders like stability. Yeah. So not to the same degree that you can with a whole life policy. So there's some added benefit there. But really, again, that kind of comes down to what are we trying to accomplish, and what's the personality type of the business owner. If we have a business owner that's my investments, I want to swing for the fences. Yeah. Okay, well, we're probably in universal life territory. Yeah. If we have others that are like, in my business, I swing for the fences. I'd like more security and more certainty, and I don't want to tie up my cash flow. That might be a better fit with whole life.
Yeah. And I was thinking, what are some mistakes that people pick the wrong policy, or do you see people will pick something, but they should be picking universal or whole life? Yeah. Like I'm right now trying to figure that out for myself, just in a term policy, and I think I need to think about choosing something else yet.
Yeah. Yeah, and the beauty of having that term policy is you have some runway. Yeah. I know you're a pilot, so I use that analogy. But you have some runway to make that decision, which is great. Now, when it comes to, particularly when it comes to whole life, the sooner you make that decision, the better, because it's lower cost to you.
Lower cost.
And yeah, depending on how you structure your universal life, the same thing could be true. But when we look at mistakes that people make, I think mistakes people make is they will overcommit. That's the number one thing I see. They will overcommit. So they'll go, whole life, my premium is $10,000 per month. Now, I know that sounds like a crazy number. Yeah. You can do a whole life for $200 per month. It just depends on your cash flow. Yeah. But they'll see something for $10,000 a month. They'll go, yeah, I think I could do that. And then they'll get into the weeds with it, and it's like, whew, this is hard. I don't know if I can actually continue it. And even with IFA, you have to, with the immediate financing arrangement, when you're borrowing the premium back, you have to account for the cash flow of making those interest payments on the loan. You're not paying back the loan, but you still got to carry the interest, albeit tax deductible and all that. So as business owners, we're a pretty optimistic bunch again. So we need to have somebody that sort of tempers. So lots of times I'll have conversations with clients where I'll say, like, what's the dollar amount that you can just like, you wouldn't even notice it coming out of your corporate accounts? Oh, yeah. And sometimes they like to sound impressive. And so they'll be like, oh man, I could do 10 grand a month. Okay. It's like, okay, let's start with 4. Let's bring it down, and let's start with that number and see how comfortable that is. And I find a lot of times they appreciate that. They're like, okay, cool. I can start lower and I can always increase, So it allows for us to have those good conversations without overcommitting. Yeah. Other mistakes I see with choice is they'll kind of take an aggressive approach at the beginning, particularly with universal life. They'll say, I'm going to put in $10,000 per month. Make sure I have enough room, because there's some rules around how much you can put in. Make sure I can put in $10,000 per month. Then they never put in more than 2. Well, it's not going to run very efficiently. Yeah. And so I would far rather have it structured to max out at 5, so we don't have so much cost in the policy, and make it super realistic. And maybe we add some term so they can convert more later if they do want room for 10. So things like that.
Yeah, makes sense. Okay. I know you touched a little bit on that, but I had a question here. Why is life insurance so important when you have business partners?
Yeah, great question. Great question. This is, you asked about mistakes that business owners make. I see this one probably most commonly. They'll get their unanimous shareholders agreement together, but then they don't think about, if somebody dies, how do we pay it out? So if you look at leaving that risk uncovered, here's what could happen. Let's say that we have, actually I went through an example of some business owners that was prepared by our accounting team. Yeah. Let's say you have a $3 million payout that has to happen. That $3 million payout going to the spouse. That's a massive impact on the business. But people see it as a $3 million impact. It's not actually a $3 million impact. You have to now figure out where I'm going to get that money.
That's right.
And how am I going to flow it to the spouse? And so there's tax on tax sometimes. Sometimes we see triple layers of tax.
Yeah.
Now, I'm going to come back to that in a second, that example, because we'll probably talk about tax consequence on death. But when it comes to the partnership, what can happen, first off, if we don't have a proper unanimous shareholders agreement and my business partner passes away, I am now automatically in business with whoever they named as the beneficiary of their shares. A unanimous shareholders agreement will protect me from that because it says I have the right to buy it out and they can't refuse. Now I just need to figure out how I'm going to pay for it, right? So again, if I don't have any life insurance on my partner, now I got to try and find a way to come up with that $3 million or that $200,000 or that $20 million. We don't know what that number is. If I have life insurance in place, I have literally paid pennies on the dollar.
Yeah.
It pays out, and it pays out tax-free to the corporation, completely without tax. So now I have $3 million of net money in my corp. The beauty is when I have a tax-free payout of life insurance specifically, it creates a credit in an account. It's a notional account called the capital dividend account. So if you ask your accountant, they'll know exactly what we're talking about. It creates a credit for $3 million in the capital dividend account. So now I can flow that $3 million out through the capital dividend account to the surviving spouse with zero tax.
Okay.
So the company experiences no tax, the surviving spouse experiences no tax. And so we've completely avoided these double and triple tax layers by having life insurance instead of trying to come up with the cash internally, selling assets, selling a building, whatever the case may be.
And the other night when you had your presentation, you talked about the triple tax and all that.
Yeah.
Can you go through that a little bit? What happens when, the first spouse passes away and the second, and how the taxes even work around that?
For sure. And in that example, we were talking about just that, where we were saying first spouse passes, second spouse can inherit those shares. Not talking about a partnership now. I'm just talking about, let's say it's you and your wife. Okay? So then the wife can inherit that business, albeit could be very difficult if there was no insurance to hire other people to help out and come alongside and new business managers and all that kind of stuff. But that's an aside. But when that second spouse passes, we can't pass those shares to the next generation without tax. So something happens that's one of the most painful things, I think, and it's called a deemed disposition. CRA says, oh, we're going to pretend you sold that. Let's just pretend for a minute, right? So you didn't actually sell anything. The shares are still there. The shares may be even illiquid. You might not be able to sell the shares, but they want their tax money as if it was sold at that point. So now the shares are in the hands of the kids. And the example we were using was that there would be a cap. I think we had if I'm not mistaken, $11.2 million company, and $3 million is now due in taxes. So there we go. We owe $3 million in taxes, and it's now on the kids. Okay, so now the kids are going, where do we get $3 million? Okay, so they own the company. So they go to the company and they say, okay, do we have some things in here that we could use to pay that tax bill, because they don't have the personal assets to pay it. The problem is to pull money out of the company, it has to come to them personally before they pay the tax bill.
That's right.
That's crazy.
That was kind of the aha moment for me. It was crazy.
So the tax bill to pay them the dividend ends up that they actually have to liquidate from the company, net from the company, about $5 million and change. So they have net $3 million to pay the government. So that's the first layer of tax. The second layer of tax, well, it's actually around the second layer. The third layer of tax is now we have to sell something in the company to create the $5+ million.
That's right.
To pay out a dividend that will net them $3 million. And that number, if it was just best case scenario inside of a company, i.e. a capital gain. So let's say we had a building and we could sell that building. That building would have to sell for $7.8 million to pay the capital gains inside the company. So they've got the $5+ million to pay the dividend to net out $3 million.
Wow.
So you have an $11 million plus company.
And now you're costing you $7 million
7.8
potentially in taxes.
7.8 if you haven't done the planning properly. Now, what did it actually cost you just to buy some life insurance? You know, like that. Those are why we don't want business owners avoiding the topic. We also don't want to pressure them. You know, this is. I always say to business owners, life insurance isn't a need.
Yeah.
It's not a need. Nobody's going to say you have to buy this to be in business. You don't.
Yeah.
If you buy it, good for you, because this is what you're avoiding.
Yeah.
This is what you're planning ahead for with your for your kids, for your, in my case, grandkids.
So I was thinking later on or afterwards, I was thinking like, is there ways where you can take the kids into the business sooner where they're shareholders? Does
Yes.
that make a difference?
Yes.
Yeah.
Yeah, it does. Having kids, and then we can get into family trust planning and things
Yeah.
like that too, which we might not have time for all that today.
Yeah.
But bringing kids on as shareholders in the company is helpful. There are some tax considerations when you're bringing them on as shareholders.
Okay.
If you're bringing them on as shareholders from $0 and they can grow their own share base, that's great.
Yeah.
But if you're bringing them into shares that are already existing with a value,
I was wondering about that.
yeah, there's some tax planning that you got to do around that. I'm not saying it's not possible, but just got to do some good tax planning. You need a good tax, typically a good tax lawyer around that. So you can bring them in, and then those shares can, obviously they're in their name now. So we're not concerned about those shares on mom and dad's death. But when we have legacy planning, we're still concerned about those shares because at some point, those shares are going to pass to another generation. So you still got to be thinking about, if we're doing it for mom and dad, now we got the kids involved in the business, we need to be thinking about it for them. Because ultimately, the goal in business, I think, is maybe the goal in business is an exit plan. Sometimes the goal in business is a legacy plan and make sure that this business can out-survive us.
Yeah. And I had, in closing here, what does success mean to you today?
So for me, specifically, success means to glorify God. I want my work to be full of integrity. That's one of our 5 values as a company, is integrity. I want our clients to feel like we're actually working for them, not for us. You know, so to me, that's actually more of a spiritual dynamic than anything else. So on that level, I want my work to glorify God. One of our foundational principles is do to others as you'd have them do to you. So what does that mean? Well, even in our whole client onboarding process, we constantly meet with clients and say, now leave. Go think about it.
Yeah.
Go chew on it. If you're a praying person, go pray about it. Because we want them to have the respect to make their own decision, not somebody talking them into something. What that's yielded for us, by the way, is just tremendously loyal clients, because they've never felt cornered. They always feel like it's their decision.
Yeah.
So to me, that's success. If we can actually have clients that have a high degree of loyalty because they've been respected through the process and so on. On a personal level, beyond that is family. You know, I've got 4 kids.
Yeah.
They're all grown now. They are our best friends. I'm not sure that's healthy. They're our best friends.
Okay.
We do everything together. We love to travel together. And my kids recently got me into golf. And oh my goodness, now I'm addicted. And we do it together as families. And we got grandbabies running around on the green. They pick up your ball, throw it in the hole. We count it, you know.
Well, that's the way it should be.
It's a lot of fun. It's a lot of fun. So to me, I do feel, not that I've arrived at personal success, but I feel like I've been pretty blessed to have that kind of dynamic in our family and in my life.
Yeah.
The primary success in that is my marriage, not my kids, not my grandbabies. All that's awesome, but they are like, we always said when we were raising our kids, they're guests in our home. But the most important part is our marriage. So there's something really kind of, it's not I don't think it's necessary for a good marriage, but there's something really special about being able to be in business with your spouse. And you both do things totally differently and bring different strengths to the table. So to me, that's a high measure for me of success is our marriage solid? Is our family solid? Are we enjoying all being together still? And you know, do the grandbabies get brought over at least a few times a week? You know, that kind of stuff. So on that side, and then financially, I haven't honestly really paid attention to the financial side. We recently went through a process where we decided that we're going to be offering for sale a good percentage of our company to our advisors.
Okay.
And as part of that, of course, we had to go through business valuations and all that kind of stuff. And that's kind of the first time I've ever sat down and went, how did we do? You know,
Yeah.
and it was a fun experience and all that kind of stuff. But to me, I value on the financial side, I value first being able to give.
Yeah.
I generally set goals around giving. I'm not going to talk about those,
Yep.
but generally set goals around giving. And I don't feel like I've done as well as I'd like to do on that area. That's an area I still want to improve in and grow in. I've heard these amazing stories here in your town about just what guys are doing for not only ministry, but in community. I'm like, wow, that's something to aspire to. So
Yeah.
I've been inspired in the last couple of days, visiting with some of you guys and seeing what you do community-wise. So new success metric for me.
Yeah.
And then, beyond that, being able to take care of my family,
Yeah.
being able to leave a legacy, that's super important to me.
Yeah, I had a question here. Like,
Yeah.
what do you see your legacy, or what would you like to leave behind?
Yeah.
What's your
Yeah.
legacy?
A lot of life insurance. It's all tax-free. No, what I'd like to leave behind is what my dad's left me. You know, my dad's not left me yet, but my mom and dad are, they're just heroes. So when I look at what they left in terms of legacy of a deep spiritual life, that's probably my most valuable thing that I would like to somehow pass along in some measure to my kids, my grandkids, and maybe one day my great grandkids.
Yeah.
And then from a financial perspective, well, first of all, from a marriage perspective, I would love for my kids to look at our marriage. We've been married 32 years. I'd love to look at them to look at our marriage at 50 and 60 and maybe even 70 years.
Yeah.
And go, that's what we want. You know, so keep that's not hard.
Yeah.
That's not hard. I was going to say keep running that race. That's not hard. That's a pleasure to be with my wife. And then the next thing would be, I do want to leave a family legacy financially. But most importantly, I want to leave kids and grandkids that know how to handle it.
Yeah.
Because I've seen a lot of examples of people that have received large amounts of money and it has not been good. It's destroyed families.
Yeah.
And I've seen the opposite.
And that's been a lot of times my question in my head is, why do I want to leave a lot behind, and how about if they can't handle it and it actually destroys them?
And there's some careful planning
around that too, right?
Yeah.
Yeah.
Yeah, there's some things you can do with family trusts and careful planning to make sure it's a blessing instead of a curse. I've recently had the opportunity to talk to a few folks that are in that legacy phase, and one of the things I always encourage them to do, I don't think there's anything wrong with leaving money to charity. It's great.
Yeah.
But one of the things I always encourage them to do is to think about leaving money to ministry and charity through your kids, through your grandkids. Involve them in it.
Yeah.
And if you haven't involved them in life, which I think that means like start, involve them in your life so they can be a part of giving. You're not bragging to your kids when you're giving away money or supporting different things, but involve them in that process.
Sure.
That gets them inspired. They see the good that it does. They see the value it brings. The giver is always more blessed.
Yeah.
So involve them in the giving. And then you can plan your legacy around, you're giving money to your kids, you're giving finances to your kids, maybe a company to your kids, but you also have implanted that legacy. And then you can put in your wishes, like, I would like for all of you to take X% of what you received and go give, like just enjoy the next year, giving away money. And I think that could be pretty special.
For sure. Yeah. Every time we had the opportunity to give, it's something that feels so special.
It does. It's a privilege.
Yeah. What is a question I haven't asked that I should have asked you?
Oh my.
About life planning and insurance and all this.
Yeah, I think a closing comment is it's not that scary. It's not. There's people that know how to do this stuff.
Absolutely.
but I would caution this, and that's there's no one person that knows how to do it all. You know, if somebody comes to me and asks me a question that I don't know, I don't know. You know, there's people that we have on our team that if we put all those heads together, it's extraordinary.
Yeah.
So it's not that expensive and it's not that scary. But a lot of times we avoid those things because it's mystery and I don't know what it's going to cost and all that kind of stuff. Just get the facts.
Yeah.
And once you have the facts, then you can make some good decisions, and
Yeah.
don't let anybody pressure you into
Yeah.
those decisions. Just have some time.
Yeah. And so, final question: the listener could take one action after hearing this interview. What would that be?
Yeah, so if we're talking about the average business owner,
Yeah.
I would say the very first thing they should do is just look at their corporate structure. We didn't get into this today, but I think holdcos are incredibly vital in corporate structures.
Yeah.
They protect us. They allow us to be able to sell that operating company later, get full value, sell it as a share sale, get lifetime capital gains exemptions, all that kind of stuff. So if you're not super comfortable with corporate structures, reach out. Let's have a conversation. Talk to your financial advisor. Talk to your accountant and really get a handle on, do I have the right corporate structure? The only way to determine if you have the right corporate structure is to know what your vision is. Where are we going with this company?
Yeah.
Is it something I'm going to sell one day? If it's something I'm going to sell one day or leave to my kids, I better make sure it's structured well now, because I can save literally millions of dollars down the road if it's structured well now. So start with your corporate structure and have a good conversation with your team of advisors around you.
Awesome. And if people wanted to reach out to you, how can they get a hold of you guys?
Yeah, you can find us on solomonfinancial.ca. Solomon is spelled Solomon, like the king. That's what it's named after.
Yeah.
He was pretty wise.
Yeah, absolutely.
And not too poor. He did pretty well. So that's solomonfinancial.ca. That's where they can find us.
Okay.
They can reach me at dan@solomonfinancial.ca. And you know, I'm not checking my emails minute by minute, but I have a wonderful assistant that does run through those and will make me aware if somebody's trying to reach out, and then we'll put the right team around you. It's not a one-man show. We gotta have a team to do it right.
Awesome. Well, this is such good information. Really enjoy you coming to our town here and talking about all this. So really appreciate you taking the time for this. And thanks for being here.
Yeah, and thanks for having me, Willy. I've just enjoyed this visit. I've come to Crete now several times, and every time it's just extraordinary to me. This is a unique place. It's blessed. So yeah, thanks for having me.
Awesome. Thank you.
All right.